Alright guys, welcome Chapter 4, Investment Companies, Mutual Funds, Exchange Traded Funds, Closed-End Funds, and Unit Investment Trusts. Okay, objectives here: understand the concept of a mutual fund, distinguish between closed-end versus open-end funds, explain the difference between load and no-load funds, compute the net asset value, identify key information sources for mutual funds, explain how to evaluate performance of mutual funds. I actually teach a whole course at Bunker Hill Community College on this one chapter. So I'm going to try to condense all that information into the few short minutes we have. Okay? Investment companies, okay? They were formed in the Investment Company Act of 1940. In my classes, I try not to focus on trivial stuff that will never affect you in the workplace. The Investment Company Act of 1940, unless you get a career in finance, compliance is not going to be too relevant in terms of quizzing you on it. It's a very complicated topic. However, in terms of the textbook, it's a footnote. They say the Investment Act of 1940 did XYZ. It obligates the SEC to regulate investment companies. There's a lot more to it than that. But for the sake of this class and most classes I teach, it's a trivia item. I won't ever ask you, what year did the Investment Company Act occur? Why? Because no one will ask you that kind of stupid question. Okay? Investment companies include mutual funds, exchange-traded funds, also known more commonly as ETFs, closed-end funds, and unit investment trusts. So, mutual funds, percentage of households that own mutual funds from 1980 was 5.7%. Now 2009, which actually 2012, but as the book says, 2009, 43% own mutual funds. Why is this? The primary driver of the increased use of mutual funds in the U.S. has been because of the shift away from pensions, where your company would, pay for your retirement at a certain age, you get the retirement, and you don't have to worry about it. Your company is going to pay you from the day you retire to the day you die. Under this scenario, under the new scenario, we're now a more 401k focused society, which is also called a defined contribution. Okay, you contribute a certain amount, your company matches it, hopefully, and then they're done. Their obligation, you don't see me, I'm washing my hands right now. Okay, they're washing their hands of their obligation to you. It's actually better for the company, of course, if a 401k plan, because they make their one payment then to your retirement, and they don't have to worry about it in the future. Because with the pension plan, there's so many X factors. This is why all those car companies are in trouble with their unions and stuff like that, because they have to pay all these pensions for the union workers, which is not a positive or negative thing. It's just a fact. But, let's say the, morbid topic, but let's say the average life goes from 70 to 85. GM is on the hook to pay these, pensioners till the day they die. Under a 401k plan, the responsibility is on us to be responsible investors. Sorry to use the same word in one sentence. So, mutual funds increased because people had to select investment professionals on their own through the use of 401k accounts. Okay, and that all happened in the 70s, and the chart here starts at 1980, and we see a rapid increase. This is also partly, for the increase in financial jobs as well. Okay, advantages and disadvantages of mutual funds. Number one, diversification. Again, you don't want all your eggs in one basket. Most mutual funds hold a wide variety of stocks. Professional management, time savings. You don't have to do the research on your own. Performance. Hopefully you're getting better performance. Expenses. Expenses can be a negative, right? If you're in a very vanilla, which means plain, passively managed, which means the mutual fund manager is just matching a benchmark, mutual fund, then the fee is going to be pretty low. But if you're in some kind of funky quantitative mathematics model based active mutual fund, then it's going to have higher expenses than other mutual funds. So the expenses, keep an eye on it. Are the expenses high? Selection problems. If you pick, a gas and oil mutual fund at a time when gas and oil prices are dropping, guess what? You made a poor selection. The manager could be the best manager in the world, but if you're in the wrong sector or region, you could still lose a lot of money or make a lot of money. Okay. Diversification. Okay, so we have some industries here. Okay, automobiles, banking, chemicals, computers, financial services, etc. And then we have some companies that represent those. Choose securities from different industries. The economy does not affect all industries equally. For example, a great defensive company to be involved in would be like a grocery store or McDonald's, right? Because guess what? If the economy starts doing really crappy, you're not going to stop buying groceries, right? You might stop buying iPods though, right? Or maybe not, right? If the economy's doing really well, McDonald's and the supermarket might underperform the market, but you're using them as a defensive company, right? Closed-end versus open-end funds. Closed-end funds have a fixed number of shares, okay? Cannot buy the shares directly from the fund. Limitation on shares outstanding. Fund does not stand ready to buy shares back. Purchasers and sellers must trade with each other. Shares of closed-end funds trade on security exchanges or over-the-counter just like stocks. Closed-end funds are not as common. Let's talk about that. Okay. Net asset value. The current value of securities owned by a fund minus liabilities divided by the number of shares. So net asset value is basically the price of the mutual fund. It's the securities minus the liabilities divided by the number of shares. Very simple calculation. Okay. One of the most important consideration in purchasing a closed-end fund is the trade or the discount or premium from the NAV. I said that in the previous slide that closed-end funds aren't as common. They're becoming less common. Open-end funds like ETFs are becoming more common. Closed-end funds like mutual funds are becoming less common, but not obsolete by any stretch of the imagination. Formula for net asset value. Here we go. Boom. Value of securities minus liabilities over shares. What could liabilities be? Could be the expenses, right? What you're paying the investment manager to manage your money, right? Open-end funds, opposite of a closed-end fund. Always ready to sell new shares. Always ready to buy back old shares. An open-end fund is the equivalent of an exchange-traded fund. It's an ETF. Okay? ETFs are generally passively managed. They're set up to match a benchmark. Now, in Chapter 3, we talked about some benchmarks. Now, you're like, well, we only saw like 10 or 15 benchmarks back there. Well, there's 10 or 15 benchmarks that we saw, but each one of those benchmarks can be sliced up and diced up and customized 100 different ways. So they're still passively managed. We could have the S&P 500 energy benchmark, right? And that's a very specific benchmark. But if I was managing a mutual fund that focused on energy, I wouldn't want my benchmark to be the S&P 500. I would want it to be the S&P 500 energy index. Closed-end fund versus open-end fund, just a little graph. You guys can look at this on your own on the slides. Exchange-traded funds, what I was just talking about. Investment company shares that trade on stock exchanges like common stock. Funds that mimic some index, right? They're tracking an index. The portfolio managers don't have to make a decision on what to buy and what to sell. They're mimicking the index. They're passively managed and therefore low cost. They're also tax efficient. They focus on countries, sectors, regions, indices. Okay? As I said before, I forget if it was this week or last week, I'm pretty much a macro investor because I work in the investment industry and restrictions that are placed on me because of this. So I primarily invest in ETFs for this reason. I might say, well, I think the Brazilian economy is going to do really well with the World Cup and the Olympics coming up and, whatever monetary and fiscal policies they have. I will buy a Brazilian ETF that will match the performance of their stock market. I can do that with any country almost in the world. advantages. Okay, they're marked to market. Okay, they trade at their NAV. Okay, so whatever is the stock, the basket of stocks is worth, is what it will trade at. Okay, they can be traded all day long. Mutual funds, forgot to mention this, are only traded once a day. Okay, they're only traded once a day. You put your order in at any time during the day, but the order doesn't go through until the end of the day after the market's closed. And the reason is, well, you're like, well, why would I buy something if I don't know what it's what's going to cost? Because mutual funds are diversified, there generally isn't very, very large daily price swings. Okay, you generally won't see a 20% swing in price on a mutual fund from day to day, because one stock might go up, one might go down, etc., etc. No real research costs in ETFs and lower expense ratios than mutual funds. Why? Again, because it's tracking an index. More than 95% of investment funds are now open-ended. Transactions are made at net asset value. Mutual funds are open-ended investment companies. I made a little mistake earlier, and I'm going to correct myself. It happens from time to time, and I'd rather admit to a mistake here than have to redo this whole lecture. So mutual funds can also be open-ended investments. There are some closed-end mutual funds as well. This can obviously be a confusing topic. However, we're going to continue to move on. Okay. Distinction between closed-end and open-end funds. Hopefully this will clear up any confusion from me as well as you. Okay. Closed-end funds trade over the stock exchange. They have fixed number of shares. There may be a discount or premium on the net asset value, and there will be a commission. Okay. Open-end funds. Okay. There can be a load or no load. We didn't go into that. It's more given in detail in the reading. Okay. Basically, are your commissions charged at the beginning, at the end, or evenly throughout the purchase? Okay. Load versus no load funds. A load fund commission can be 5.5% or higher. Low load funds can be 2 or 3%. Back end loads, there can be an exit fee of 2.2 to 3%, but this can decline maybe to 0 over time. And a no load fund is deceptive in its name because it charges a persistent fee constantly. So if you're going to hold a fund for a long time, maybe over 5 years, if that's your outlook, a back-end load might be the best way for you, because if you hold a fund for more than 5 years, a lot of times they drop their commission. Okay? And this has to do, again, with stuff that I'm not going to go into too much detail on this chapter. It has to do with how everyone gets paid when there's an investment fund. Okay? So brokers get paid from the management company. Okay? And it's easy, and that's what they're used for, right? Who's getting this commission? The person selling the fund, hence the word commission, right? In the back end load, the investment manager will have to compensate the broker up front and then get compensated in the back end. But they're going to constantly make fees throughout the management, through a management fee. There's a difference between load fees and management fees. Guess what? You're realizing there are a lot of fees in mutual funds. You're paying for professional management. No loan funds do not charge commissions. How do load funds justify their existence? They charge consistent 12B1 fees. Okay? Load funds have similar management fees as well. Why buy load funds when you can buy no load funds? Studies indicate no difference in investment performance of a load and no load funds. It has to do with, obviously, they're all like snowflakes. Okay? Everyone's different. You have to look at management fees, and there could be a manager who has different classes of shares, and different classes of shares have different fee structures. They might have different minimum deposit requirements or investment requirements. These are things you're going to need to research on your own. Okay. Application example. Look at this. Do it on your own. I may quiz you on it. Let's move forward. Okay. New net cash flow to no load funds continues to grow. Okay. People like the idea of no load funds better than paying a large commission up front or at the end. Surprise, surprise. Differing objectives and diversity of mutual funds. Okay, there's money market funds. Okay, money market funds invest in short-term securities, U.S. bills, euro-dollar deposits, commercial paper. There's no load. There's a small minimum deposit. There's check writing privileges. It operates in a lot of ways like a bank account. Okay, money markets funds were invented kind of, I don't know the exact date. Like I said, I don't pay attention to this trivia stuff either. Let's say it, 30 years ago, where if you had above, $100,000, you would get a higher interest rate from the bank, right? So what these smart investment managers did was they took people who only had smaller amounts of money and they pooled their money together so that they could reach that high threshold for the higher interest rate return, so that they could then provide an excess return from a standard bank account. Now, money market funds don't perform all that differently from a standard bank account. Okay. Growth funds, capital appreciation, invest primarily in stocks. Aggressive funds can use leverage, right? What's leverage we talked about before? Leverage is also considered margin. You're buying assets that you don't have enough money to buy. Regular growth funds invest in more stable firms. They're not fully invested in stocks during market decline. Think about that, right? We can have in our prospectus, right, which gives us all the details about our investment. We can hold a certain amount of cash position. We can get what's called a cash lag. Okay, cash lag when the market's going up will negatively hurt performance because we're not fully invested. But when the market's going down, the cash lag will act as a positive because we're cashed out. Growth with income may pay dividends, attractive to investors. To investors interested in capital growth with base of dividend or interest income, less volatile and risky than growth funds. Why are income-producing investments less risky? Well, think of it like this. If a stock is willing to pay a dividend, it's because they have no better investment options than to pay their investors excess cash, right? They have so much money they don't know what to do with it, so they're going to give it to their owners, you, the shareholders, right? But if you're in a smaller company that's growing, guess what? You're not going to pay a dividend because you're going to take all that extra money and reinvest it back in the company. But in that sense, you're also a riskier company as well. Balanced fund combines stocks and bonds and other preferred stock. Preferred stock pay dividends and interest. Try to provide income plus some capital appreciation. Okay, index funds, they're passive. They're a lot like ETFs. ETFs are index funds, but mutual funds can also be index funds. Okay, they replicate a market index as closely as possible. The stuff we've already went over before, and just like ETFs, lower transaction costs because there's less management, less research, less manpower involved. Okay, bond funds, variety of different bond funds. I recently, as an investor, have started investing in bonds. Not bond funds. I actually bought my first bond last year. I bought the Netflix bond. Why did I buy Netflix bond? When you're buying a bond, you're basically making a bet that the company's not going to go bankrupt. Based on the perceived risk, it gets assigned an interest rate, just like us with credit scores and our credit cards. And the Netflix bond is paying somewhere around 8.5%. Okay, 8.5%. At the time of this recording, is tremendously higher than any bank account I can get in the U.S. And I consider Netflix to be a very safe investment. I don't think it's going to disappear. Why? Because that's the way the technology is moving. Okay. Netflix would actually be considered a high-yield bond, and it's going to have a higher risk of default compared to, let's say, a utility company. Okay. So we have corporate bonds, Coca-Cola, government bonds. I can buy a bond for a lot of cities and towns in the U.S. That's actually more of a municipal bond. Government bonds are more like T-bills. Municipal bonds are like buying the bonds for a city or town. There's a benefit for municipal bonds. They don't pay taxes on their interest that you receive. So what that does is that allows the city or town to only have to pay 4% interest. tax-free. So the 4% interest tax-free is actually equivalent to, let's say, a taxed interest of 6%. Make sense? If not, email me. We can go over it. Okay? Risk of loss. Sorry, the dog's barking. Dog. Shh. Risk of loss of principal during rising interest rates. There's little interest rate risk if you're holding the bond to maturity. Okay? If you're going to sell the bond before it matures, before the initial investment is paid back, then guess what? That interest rate volatility is irrelevant. Okay? Bonds, just like stocks, have different sectors you can invest in. Okay? Also, there's foreign funds. There's global, international, specialty. You can buy a water fund that only invests in water companies. Why would you do that? You believe maybe you believe that there's going to be an explosion of bottled water consumption in Eastern Europe, which there has been over the last decade. Okay. Here's a short list of internationally oriented funds. Differing objectives in the diversity of mutual funds. So there's target or life cycle funds. These even dumb it down further for investors who don't really care to be involved in the day-to-day management. I could buy a 2045 target date retirement fund. Basically, that fund is going to be geared towards an average person who wants to retire in the year 2045. And it's going to adjust the risk accordingly. It's going to rebalance the risk every year to compensate for my age in that cycle. Okay? So, all things being equal, the older I get, the more bonds I'll want to hold in my portfolio and the less stocks. Why? Because when they're held to maturity, bond prices are not volatile, and stock price, unless they go bankrupt, and stock prices can be very volatile. We hear in the news more so, 2 years ago than today about, some, person in their 50s lost all their retirement money when the stock market crashed. What the hell were they doing having all their retirement money in stocks? Not that I completely blame them, but some of the blame is on them for those poor investment decisions. Okay, matching investment objectives with fund types. Okay, so you want to be concerned with volatility, the safety of return, and how aggressive or less aggressive is the stock growth. Okay. The prospectus, mentioned this in passing earlier in the chapter, contains information regarding the funds, investment objectives and policies, the holdings of the fund, management fees, and turnover rate. How quickly are they buying and selling stocks? If they're buying and selling stocks a lot, just like if we were buying and selling a lot of stocks, there's going to be a higher fee for that kind of stuff. Just stuff to keep an eye out for. Not necessarily positive or negative, just be aware. Okay? Distribution and taxation. Securities sold by a mutual fund manager can result in capital gains or losses for the fund. Okay, if you're sensitive to taxes, that can be important for you, and you'd want to be aware of that. Okay, you can choose when you buy your own stock. You choose when you buy and sell. I mean, you can almost construct your own mutual fund by buying a portfolio of 30 different stocks. But then you're becoming the investment manager. The mutual fund manager decides when to buy and sell securities. You have the capital gains and losses at the manager's discretion. Okay? Shareholder services, automatic reinvestment, safekeeping, exchange privilege, pre-authorized check plan, systematic withdrawal plan, and checking privileges. These are things that when you buy a mutual fund you can expect. Or some mutual funds, I should say. Investment funds, long-term planning, dollar cost averaging. Guess what? I want you to do research on this on your own, and I'll quiz you. Know what dollar cost averaging is for the quiz, okay? Here's a little slide on dollar cost averaging, okay? But, like I said, I want you to do the reading, okay? We're going to pass this slide, way too small for me to go into here, okay? Measuring mutual fund performance averages, Lipper fund performance indexes, the American Association of Individual Investors, and the S&P scorecard are all ways you can judge, or that mutual funds are judged based on experts' opinions. There's been a lot of controversy about this over the last few years, about how they're judged and how a risk of a mutual fund manager is judged, but that's a topic that is too lengthy to have for this small of a lecture. Okay. Computing total return on your investment, very simple calculation here. Beginning NAV, ending NAV, what's the change in NAV, also account for dividends and capital gains. Okay? So we have some key information here. $1.77 plus a change in NAV. Okay? $1.77 over the beginning NAV is $14.05. Again, we're seeing here a change in NAV of $1.05. Okay? $1.05 plus $1.72 is $1.77. That's where we get the $1.77 over the beginning NAV to get the 12.6%. Unit investment trusts, I think we're wrapping up the chapter here. They're investment companies organized for the purpose of purchasing a pool of securities. They're usually tax-exempt municipal bonds. Okay? Passive investments that have been in decline. Distinctions from mutual funds, UCITS as they're called, are formed with the intention of keeping assets purchased until maturity. So when you're investing in a unit investment trust, you're locked in, right? There's generally not too much selling early unless you're exchanging between another party. And they usually focus on the preservation of capital. Okay, that's it for today, class. Enjoy your weekend and email me with any questions.